cost of goods sold tab. And here we have 4 different areas that we want to edit. We've got our field labor, equipment, materials, and subcontractors. Cost of goods sold is anything directly related to a project. It's not overhead, it's not for the company, it's specific to a project. So if you take your revenue or sales, total sales, and you minus your cost of goods sold from that, that would give you your gross profit. And then to get your net profit, you would then minus your overhead to give you your net profit, whatever the business has made. So for our cost of goods sold, we're going to come down here and we're going to input our employee name, our position for our employee. Once again, these are just for your reference, but any input that you put into the employee name here will add up the number of field employees that you have. So you want to make sure that you don't put a space here and leave that blank, because now you'll have 4 employees when you really only have 3. Because we put a space there, I'll take that out and we'll go back down to 3. So you just want to make sure you're cognizant of that. And for your hourly wage, this is whatever you pay your employee. If it's salary, calculate it based on your total working hours per year, not your total production hours per year. So that's just one thing that you want to note, that this is an hourly wage. If you do pay salary, you'd want to multiply that and give it the total amount per year. And if you do put salary here, you'll want to change your hours to just 1 and not 1620, which is your total hours, working hours per year. You can see also that our hours are green. This means that it is editable. So if you do have an employee that's part-time, you can take them down to however many hours that you want to take them down to, not 1620, but maybe they're part-time and they'd only do 800 hours. So now we have them as part-time. So anytime I add another employee here, if I employ employee C, we'll just put position in there, we'll pay him $20 an hour. I can't drag this down because that'll just give them 800. I'll actually just want to copy this field formula and put it into here. And then whenever I have a formula missing, I just drag down that box and that'll take me to that. So that's just how we go about adding and dragging down these formulas to make sure we're calculating each one correctly. Once again, when I put my hourly wage in here, it's not necessarily what I'm paying myself, but it's a fair market value for what it would cost me to replace myself in the field specifically. The last thing that we want to do here is our labor burden percentage. This is a markup on your hourly wage or your total to be able to cover things like insurance costs for employees, payroll taxes, vacation pay, any bonuses. This is a number that if you talk to your accountant, they can come up with a good percentage or even very specific hourly amounts that you can add to their hourly wage for each employee. But this is something that you'll want to do a bit of research on to come across what a good labor burden percentage is. Or once you're actually paying your employees, you'll notice a discrepancy between their hourly wage and what you actually have to pay on top of that with payroll. With this, we'll get a percentage of revenue. We'll get our total field wages, our burden, and our total field payroll. On top of that, we'll get our number of field employees, our total field employee hours, their production hours, and their total unbillable hours. Now, to continue with cost of goods sold, whenever you're pricing a project, these are things that you need to add whenever you're quoting a project. You'll need to add your employees that are assigned to that project or an average hourly rate, equipment assigned to that project, materials assigned to that project, and subcontractors. With our overhead tab, you don't have to assign those to projects. Those are recovered through our 4 different recovery methods that we'll get into later in this. So when I come over to equipment, I want to note that if I'm adding something in cost of goods equipment, it needs to be assigned to projects to be able to recover the cost of that equipment. So you can see here that we have a bunch of equipment already filled in. We're going to put the name of the equipment. We're going to put the cost of replacement for that equipment, the years of use, and the resale value. These 3 fields will give you the depreciation cost of that asset that you need to recover each year. This formula is cost of replacement minus years of use divided by the resale value after you've minus those. And that'll give you your cost per year. In addition to that, we also want to add in the expenses per year. These are things like maintenance, repairs, fuel, licensing, insurance, and anything else that you can think of. And with that, you'll get your cost per year. Now, when inputting your cost of replacement, you want to think about what it would cost you today to replace that equipment. Not what your current asset is worth, but if that piece of equipment went down today, what would it cost you to replace it today? And you can do, in this case, a truck. That's a obviously used truck that we'd be purchasing. And with that, you can then estimate the amount of years of use that you're going to get out of it. So for example, if this is a used truck, we're buying it for $20,000. let's say a used truck for 20,000 is going to have about, I don't know, 200,000 miles on it, 150,000 miles on it. Take your pick. Look at the market, what it would currently be. And I know that I put on about 15,000 miles per year out of a years of use of 7 on that. I would just add up those miles and know what my resale value of that truck would be. So let's do easy numbers here. $20,000, I get a truck with 200,000 miles on it. I know every year I put on 10,000 miles on my truck. That's an additional 70,000 miles. So 270,000 miles would be on that truck. What would that get me in a resale value if I went to sell it? That's how I calculate these 3 numbers. Add in my expenses. I usually know my fuel based on what I did last year, and licensing, insurance. Those should be things that you know each year, as well as repairs. I would look at what I did last year and maybe bump those up a bit, because that's a number that I want to come back to increase as my equipment gets older. Another question I get is, next year for your budget, do you need to reduce the amount of years of use to 6 instead of 7 now? No, you don't. This is a formula. You just keep it as is. This is just going to give you how much you need to recover. As soon as I decrease this to 6, it's going to increase my cost per year. And we don't want that. We want a consistent number here. And if you went all the way down 7 years from now, we're at 1, all of a sudden it's $20,000 a year. More likely than not, it's going to be that high. So we'll keep that at 7 to keep that formula steady. Another thing that I get asked is financing and leasing. If you want to do a formula for that, you can just put in a truck that you're going to finance. What would be its cost of replacement? Well, it would be the monthly cost of that financing or lease amount. So let's say $1,000 a year. We have 12 months in a year. That's $12,000. We'll put 1 year of use and the resale value of 0. And in that case, that's going to give us a cost of year of $12,000 there. So we're recovering our financing or lease amount for that vehicle. However, with financing, you're likely going to own that truck at the end of its life, and you'll get a resale value out of it. So it might be best to then just add up whatever your financing amount is with interest payments, put it in as a cost of replacement, whatever the years of use you're going to get out of it, and the resale value of it this way. But for leasing, this is a good formula to follow, especially if there's not going to be a lease buyback for that. Another thing we want to consider is the utilization rate. So we're likely not going to use a piece of equipment every single day on a job site. Maybe you use it half the time, or 2 out of 5 days, or whatever that rate is. What this is going to do is it's going to increase our cost per hour for that. So for example, if I only use my truck half the time, so 50% of the time, that's going to increase my cost per hour by double. Instead of 100% of the time, it's going to be 50% of the time. So every time I apply that to a project that I'm quoting and not applying it to a project that I'm quoting, I know that 50% of the time, those projects that I'm quoting, I'm recovering what I need to for that truck. And the other times I'm not quoting it on that project, so it's not increasing the cost of that project to my client. Once again, this is cost per hour. This is what it costs you per hour and not what you'd be billing for. We'll cover those in the different overhead recovery methods. Materials and subcontractors is our next one. For this, you can lump everything in as one line item, put in a previous amount that you did in materials and what you forecast for this year. You can see I've added in delivery here. You don't have to do it this way. You can just delete that, and you can add it all into one line item here, or you can list everything out in terms of maybe you do drainage work and design build work and you want to separate your deliveries and your aggregates. You can get as detailed as you want with this, or you can just lump it all into one line item. And when it comes to setting a forecast, this is typically based on your growth. So if you want to grow 2 times this year, so maybe you have 1 crew, you're going to 2 crews, you want to double what you're going to do in terms of production, maybe you're just going to double your previous amount in terms of materials that you're doing. So 65,000 I did last year, maybe we'd be at 130,000 in terms of materials. Or maybe you think that second crew is not going to be as productive, so you want to bump that down just a little bit to be able to come up with a solid amount that you think you're going to budget for materials. Where this gets tricky is where you might be adding a different service that you've never done before, and you don't know how much you're going to be selling of it. For example, you're taking on swimming pools this year. You don't know how many swimming pools you're going to install. That's where this really gets tricky. And for the idea of materials, this is why I do prefer the labor rate recovery method, because we recover all of our overhead through labor. This doesn't matter for that recovery method, but it does for our other 3 recovery methods. So this is something that you may want to be very accurate with, or you have some leeway if you choose that labor rate recovery method. But putting a number here will help you in your budget to be able to understand your percentage of revenue for each of your different cost of goods and overhead items. And then finally, subcontractors, same thing. You can lump them all as one. You can separate them. What did you do last year? What do you plan on doing this year? Is this something that you're looking at doubling? So 100% of what you did last year. So from 2,500 to 5,000, because you're going to be doing more of that type of work this year, or you've increased your crews. Or what is the reason why it's actually increased here? You have to have a good solid reason in your budget as to why you're increasing something. Are you going to become more efficient in the field? Maybe last year you weren't as efficient, or you didn't have a full schedule this year. This is just the thought process of what you need to go through when you're setting this forecast amount. And that is our cost of goods table here.